Welcome back to the podcast, the Talkin Tax podcast, with your host, Omar Aswat, Chartered Tax Advisor and owner of Aswat Tax and Aswat Global. This is episode 7, and I appreciate it's been a good few months. We do have other episodes that have already been recorded with guests. So we have, for example, the one after this will be with Richard Answer, and we'll be talking about inheritance tax planning, trusts, and wills. But yeah, we've just been. It's my fault, to be honest. I've just been tied up in lots of other places, actual client work, and I've taken a very long time to record this episode. But we're here now. We finally made it. And our senior marketing manager, Preslava, as well. She's been on my case for a few months now as well. So, but I appreciate you tuning in. And today we'll be diving into something that often gets brushed over when undertaking corporate restructures, but it's absolutely crucial, which is the accounting entries. What are the accounting entries in or on corporate restructures? Whether you're a fellow tax advisor, an accountant, a business owner involved in a restructure, knowing the accounting impact of a transaction is just as important as the tax or legal side. So I feel sometimes, like, generally speaking, the tax and the legal aspects are, at the forefront, but the accounting impact of the transaction should be or is right up there with the tax side, the legal side, the commercial aspects, the business aspects. The accounting impact is just as important. So in this episode, I'll talk you through some common types of transactions and how they're reflected in the books. I'm going to try to keep it very simple, clear, and practical. And as an overview, we'll be talking about the accounting entries on a classic share for share exchange. So, where a new holding company is inserted above an existing, to keep it simple, as I say, let's just say existing trading company. Number 2 would be dividends paid from subsidiary companies into the new holding company. Number 3, we'd look at certain accounting entries on capital reduction demergers. And finally, we'll finish with the hive-up or hive-down of assets. The hive-up or hive-down of assets within a group. Before we go on, don't forget to like, comment, share, and subscribe. And I hope you find this episode beneficial. So let's start with the classic share for share exchange. As I say, a new holding company is inserted above an existing trading company. And from an accounting, so yeah, we're not going to go into the tax side, but just very briefly on a high level, it's recommended that clearance from HMRC is obtained to ensure no capital gains tax is paid on the transaction, because effectively what's happening in the background, and it is relevant to the accounting perspective, what's happening in the background on a share exchange is the shareholders in the existing trading company are selling their shares to the holding company. So technically, you're selling shares, and therefore it's a disposal for capital gains tax purposes. Okay, and that's why we then have to access particular reliefs found in the Taxation of Chargeable Gains Act, TCGA 1992, and HMRC clearance is advisable. Why? Because effectively they are rubber stamping the transaction. They are effectively signing off that, yes, we agree with your analysis that no capital gains tax is due. From an accounting perspective, here's what happens. Now, just keep in mind that, I'll come to the subsidiaries books in a second. So, in the books of the new holding company, what is the double entry? The double entry would be debit investment in subsidiary and credit share capital. Okay, so you credit share capital for the nominal value of the shares issued. If there's a premium, the excess goes to the share premium account. So it's debit investment in subsidiary, credit share capital, credit share premium, and that's what we usually see. So, for example, if we're saying the investment was £100, debit investment in subsidiary £100, credit share capital say £1, and credit share premium say £99, that is the double entry on a share for share exchange. Now, I have a question for you. That's the double entry, that's the accounting transaction when we're looking at the new holding company. What is the double entry in the subsidiary? And you'll be perhaps surprised or interested to know that there's actually no entry in the subsidiaries books. There's no entry. It's simply a change in shareholder, and it's not a change in its financial position. Therefore, no accounting entries are required. I hope that makes sense. There's no entry. Why? Because it's simply a change in shareholder. When you think about it, nothing's really happened in terms of its financial position. Okay, but the financial position of the holding company, yes, that's changed. Why? Because, as we say, you've invested in the subsidiary and therefore you credited the capital, share capital or share premium account. I hope that makes sense. We move on to section 2 or point 2, which is dividends paid from the subsidiary company to the new holding company. Now, I have 2 videos that I recently shot where I talk about what are the accounting entries when paying a dividend from a from SubCo to HoldCo. I've got it on YouTube and it's also on the shorts version. So it's not the wide, is it 1920 1080 and then 1080 1920. I've got it in both versions and one is shorter than the other. Naturally, the shorter one is for YouTube Shorts, Instagram, and TikTok. So let's say after the restructure, which we've just spoken about, the trading subsidiary pays up a dividend to the holding company. And this is one of the reasons for implementing a group structure, for inserting the the holding company above in the first place, is that dividends are exempt from corporation tax. So this is certain planning that we undertake for clients. Why? Because instead of taking a £500,000 dividend in their personal names and losing 40% of it to the taxman, when I say 40%, I mean 33.35 or 33.75 and 39.35%. 39.35. Why? Because it was 38.1 and all the percentages went up by 1.25%, so it's 39.35%. Instead of losing it to the taxman, you can transfer the dividend to a holding company and you can undertake your other activities there. So your investment in property, investment in shares, investment in crypto, whatever else it may be. And why does it need to be undertaken in a separate company? For commercial and legal purposes. So it's the separation or the mitigation or the elimination of risk, because the investments are now sat in a separate legal entity. I hope that makes sense. Always let me know if you have any questions, and always happy to support. So we're talking about the dividend paid to the holding company. and it's a common step, and sometimes it's quite regular, or sometimes we might be looking at linked investment companies between multiple shareholders. So we have a trading company at the bottom, and then we say we have 2 or 3 linked investment companies or family investment companies that are owned by, let's say we have 3 shareholders. So dividends are constantly going upwards, and remember, dividends cannot go down. That is, for me, is with all due respect, it's bizarre to even uh, as a tax advisor, that doesn't, it shouldn't be something that I have to say. However, many have made this mistake in terms of understanding the core concepts. And that's why I like to mention that dividends cannot go down, they can only go up to the shareholders, which is the holding company. Loans can come down, that's fine, that's not a problem. And as I say, it's a common transaction. For example, when we're looking at cash extraction, or in preparation for a demerger. Demergers are complex transactions, which we'll come to very shortly, but it is a common step, especially when looking at cash extraction or in preparation for a demerger. In the subsidiaries books, what is the double entry? The double entry is debit retained earnings, credit intercompany payable, or cash. So it depends on what's happening on the ground. But for completeness purposes, we can say cash. So credit cash meaning. So effectively, I should have started this episode talking about dead click, or I forgot the other one. There's one for corporates, companies. It's Pels. Just I used to teach accounting, so it brings back memories. So we have dead click, but then we have Pels, and I like to use Pels when we're looking at companies, because dead click, the D in dead is for drawings, but that's not relevant for companies. So PERLS, we have PEARLS. So PEA is the debit side, purchases, expenses, assets. RLS is revenue, liabilities, and sales. So when we say credit cash, it's the opposite. We're reducing the asset balance. And as I mentioned, debit retained earnings. So the key point here to make is that there must be profit, or there must be enough reserves or retained earnings. Retained earnings reserves are similar or interchangeable words, not words. Sorry, it's 11 p.m. at night. I'm just going to say that retained earnings and reserves can be used interchangeably, but effectively there must be enough retained earnings or reserves / profits on the company balance sheet in order to pay a dividend. Otherwise, we're looking at something called illegal dividends, and that's a problem that can become a very messy problem for the business and the directors. Debit retained earnings, credit intercompany payable, or cash. So what is it in the holding company's books if it has received the cash? If it hasn't received the cash, then we're looking at intercompany receivable. That's fine. But I like to be complete, and for completeness purposes, the funds must physically go from the trading company's subsidiary bank account into the holding company bank account. And therefore, what is the double entry? Debit cash this time. Why are we debiting cash? Because dead click or PERLS, debit expenses, assets, drawing. So assets are going up. Or PERLS, PEA, assets. Debit cash by the amount of, let's say, £500,000, and credit dividend income on the profit and loss account. I hope that makes sense. I hope you're following. One important point to make here is that as mentioned, dividends between UK group companies are, 99% of the time tax-free under the Corporation Tax Act 2010, section, I can't remember the section number at the moment, but they must still be recorded in the profit and loss account unless subject to group consolidation adjustments. Let's move on to the capital reduction demerger, often used to separate business activities, investment activities, or prepare for a sale, effectively unlocking real value. Capital reduction demergers are very, very powerful tools that can be used. And although they are complex, we are well versed in such transactions. We've got 2 on the go currently, large capital reduction demerger cases, and we've got 3 in the pipeline. So for a fairly small firm like ours, that is something we end up getting involved in, a lot more than one would think. So in this case, a company reduces its share capital, its capital, and distributes the value to a holding company or another entity, often in the form of shares in a newly created subsidiary. So in the company undertaking the reduction, you debit share capital by the amount and you credit the distribution payable by the same amount. And then once the assets are transferred, then you debit the distribution payable. So it's offsetting contra, credit investment in subsidiary or the relevant asset or assets that we're looking at. In the receiving company, it's debit investment in subsidiary and credit share capital is the primary stance, but then it depends on the structure and it can vary. So that's that's on a very, very high level, and it depends on a lot of other things as well. For example, does it involve external shareholders? What's the final structure looking like? Is the transaction intra-group? These are different things that must be considered. There is a lot more that I can talk about when discussing the accounting entries in capital reduction demergers. But I don't know if I don't think I should go into too much detail because then it becomes very specific. We have to be looking at specific cases. But as I say, debit in the reducing company, debit share capital, you're reducing share capital, credit distribution payable, and then when distributed in specie, they might be the shares or the properties, debit distribution payable, credit investment or asset transferred. In the receiving companies, debit investment and credit capital contribution reserve. So, for example, where when a company distributes an asset instead of cash, then it's called a dividend in specie. So you debit your retained earnings, credit the investment in subsidiary or asset, and in the receiving company, debit investment in new co or asset and credit intercompany or reserves. I hope that makes sense. Finally, we move on to we said we'll discuss Hive-up or hive-down of assets. So if we're looking at a hive-up is when a subsidiary transfers assets to its parent company, and it's common when winding up a dormant subsidiary. We've got a case right now where we're looking to hive up the assets and wind up one of these subsidiaries. There are a few subsidiaries, but one of them we're looking to close up, and therefore we're hiving up the assets to the parent or the holding company. In the subsidiaries books, we would debit intercompany receivable, and you would credit the assets transferred, okay, because we said dead click or PELs. So dead, DEAD, assets. PELs is PEA, assets. So we're crediting the assets in the subsidiaries books. Why? What does that mean? We're removing the assets from the balance sheet. Does that make sense? And therefore, in the holding company, it's obvious, right? If you're following the whole double entry, how things work in accounting, which is why I actually find accounting quite fascinating. It's absolutely beautiful, where literally everything is balanced. Debit, credit. Can't have anything in the middle. When I was at college, the teacher, we used to drive her crazy, to be honest. But she used to draw, the T account on the board, and on the left hand side it'd be debit, on the right hand side it'd be credit. And when she used to ask us, does it go on the left hand side or right hand side, we'd say in the middle, and she used to go crazy. So there's no middle. It's either debit or credit, and everything ends up balancing. And so when I used to work as an accountant, things have gone wrong when the trial balance is not balancing, when the math is not mathing. So here, the opposite entry would be debit assets received. So we're increasing the value of assets on the balance sheet, and credit the intercompany payable, the loan account between the two companies. If the assets were transferred at book value, then there's usually no gain or loss recorded, unless we're looking at external parties, then we're looking at market value transactions. I hope that makes sense. I hope you enjoyed this podcast. I hope you enjoyed this episode. I hope you like, comment, share, and subscribe, and share with those that may also benefit. We are involved in many, many transactions, and my intentions are to really, start pushing more and more projects through. I try my best to, once a project comes in, get it out as quickly as possible. We are all, chartered tax advisors, FCCA as a team, and I'm looking to increase capacity by bringing in new members of staff, all qualified. And you can go on to Google, see our reviews. We have some very strong reviews. Honestly, there's so many reviews that I haven't asked for. I know I would get a 10 out of 10 review or 5-star review. I just need to get around to chasing up those clients. But we are involved in many, many large transactions, large projects, international projects as well. We have 2 different cases. With one is with an Israeli company looking to purchase shares in UK companies or UK groups, and the other is we're looking at a Swiss company, and it just comes to mind. I'm sending a proposal for a Luxembourg holding company that owns assets in Sweden. So international matters, UK corporate restructures, inheritance tax planning, property incorporations, R&D, share schemes, EIS, SEIS, whatever it may be, please reach out to us. If we're to recap this episode, as I say, the accounting side of corporate restructures is more than just ticking a box, okay? We need to make sure that the transaction aligns with the tax and the legal structuring from an accounting perspective. And just to be very clear, the tax and accounting are not always in tandem, meaning that sometimes like the advice would be the tax follows the accounting, or the accounting follows the tax, vice versa. But it's not always the case. So that's something that needs to be remembered. Also, it reduces risk. Getting the accounting entries correct from the start ultimately reduces risk. Why? Because Companies House, HMRC, future auditors, for example, if the accounting entries are incorrect, then we'll have problems, right? So therefore, it's important to get the accounting entries right. These entries also feed directly into your disclosures, so it's worth getting them right at the planning stage and not scampering around at the last minute, we, as part of our work, we provide an accountant's pack. So it's the complete detailed information for the accountants in terms of the disclosures. So for example, what are the double entries with exact figures this time? What are the disclosures on the corporation tax return, the CT600? What are the disclosures on the personal tax returns? It's not just, accounting. Then there's other stuff as well that needs to be considered. For example, what needs to be disclosed on the personal tax return of the shareholders, right? So, for example, um, on 31st March 2025, I exchanged my entire shareholding in X Limited for shares in Y Limited as part of a reorganization. So I've just got a client case up here. And then we talk about, the specific tax clearance granted, the reference number. We talk about the Income Tax Act, Corporation Tax, so Section 698 Income Tax Act, if relevant, TCJ 1992, Section 137, Section 746, CTA 2010. And, just confirming with HMRC and being proactive, actually, in saying that there's no chargeable, for example, it might be no chargeable disposal of shares, and therefore no capital gains tax arises. And then this, it just depends, honestly, just case by case. Demergers, there's a lot more that, because sometimes there's reclassification of shares, then there's the actual demerger, there might be transfers of debt, what's the notes in the accounts, SA 100, company's house, there's the legal aspects as well. So we provide a full service, a full package, which is a tax, legal, and accounting disclosures as some sort of pack. So feel free to reach out if you require our support. If this was helpful and you'd like a downloadable reference for these entries, drop me a message. We have our accountant's pack that I can get my colleague to, amend/edit so that you can utilize that as well. And if you're working through a restructure and need support on the tax or accounting side, you know exactly where to find me. Until next time, many thanks for listening. I'm your host, Omar Aswat, and Aswat Tax is a firm of chartered tax advisors regulated by the Chartered Institute of Taxation. Have a great day, have a great evening, depending on what time you're listening to, and speak to you soon.